How are you guys? Today we want to talk about imbalance and inefficiency. So when you are trading, it's supposed to be 50%, 50%, as in you understand this is an industry where we need both sides to balance for the market to move, for the market to operate, right? So what we are saying with that is we need to have something like 50% buying and 50% selling. If you are going to if you are going to buy 40 lots, you need someone to be selling those 40 lots. It's not a direct transaction which you can do, but it's something which happens automatically. The market just balances itself automatically, right? So that's what we want to talk about, something like that. I want to show you something. Let's first do a whiteboard presentation. So first of all, what we are having is, let's say we have the market like this. This is a candlestick. This is supposed to be 50% buying and 50% what selling, but the market does not move like this. It has some moments where we're having those aggressive moves. I always talk about those aggressive moves. So with aggressive moves, this is what more like 100% buying. We're just buying because the market is going up. So if in an ideal market situation, we were going to be having a market moving like this. Why? Because we're just saying banks are selling, it's a bank-to-bank transactions, right? Or we're just selling on our own, right? There are no crazy amounts involved that can move the market. So we're just selling here, buying here, selling here. So it's in a range. It's a cycle. That is 50% we are talking about. 50%, 50%. We are saying we have 50% of buyers. So let's just say we have an equal number of buyers compared to what? To sellers here. Buyers compared to sellers. So that's why we're saying 50-50. There's no a part or a stakeholder willing to go extra, where in a case where, okay, let me explain it like this. Let's say this is a double bottom, right? From this point to this point, this consolidation phase, we are 50-50. Buyers and sellers are 50-50, right? But when the market then takes out a break, takes out a high like that, it's no longer what 50-50. So it means there is inefficiency, or we have what we call imbalance in the market, right? So the moment we have that imbalance, what do we do? And how do we spot the imbalance on a chart? Let's say we are having a candle like this, right? So the next candle ideally should start from here, so this is an up candle, right? We have close, this is the close. The open should be here, and we go, right? But we have seen candlesticks where then the open will be here. This is the high. Then we open again, we go. So this high here should somehow interact with this candle. You understand? So a candlestick should not look like this. So a graph should not look like this. So we have a candlestick, right? Then we have another candlestick here. Okay, let me use a very good example of boom and crash. They move like this, right? If it moves like this, there is no balance. We are just buying, right? If we have observed boom and crashes, or yeah, let's just use boom and crash. They're either selling or buying, selling or buying. Those are the inefficiencies we are talking about. But when you are talking about other charts, the inefficiency is spotted using wicks like this. So we have a candle, a big candle, then we have a wick going here. So it means from this point here, we were 50-50, we're buying. And from this point, we're buying and selling. This is 50-50. But this gap that is left behind means we were 100% buying. We're just buying here. There is no mitigation. So this gap of this week and this week, so it's spotted using 3 candles like this, then candlestick. This gap between this week of the third candle and the wick of the first candle. This, if you draw a line here and draw a line, this gap is what we are terming imbalance, right? So how do we trade imbalance? We okay, first of all, we say we want to see an aggressive move from an order block, right? This is what we want to see. Yes. Then we want to see a retracement, steady retracement back to the OB. Then we buy again. This is what we want to see. Exactly. So what happens when there is an imbalance? When there is an imbalance in the market has to come back and balance itself. Exactly. It has to come back and balance. So how does it does that? It has to fill the imbalance. The keyword is fill, not retest. It doesn't retest, it fills, right? It retests the OB. So you have to have imbalance on top of, okay, let me just say we have to have imbalance before an order block, right? So if this is a bullish order block, there has to be some imbalance above the OB, so that price comes and fills the imbalance first, retests the OB, and we go. So we would have cleared the inefficiencies in the market and would have collected what orders. Let's go to charts. Right. So this is the chart we have. What we are having here is we are having a chart. This is Euro USD. This is Euro USD 1 hour chart. So as you can see, for now, you know how to identify order blocks. You know how to mark market structure and everything, highs and lows. You know those things, right? So what we want to do today is I want to show you the order block and the inefficiency, right? I want to bring you at, so as you can see, this is a downtrend, right? This is just a downtrend, as you can see. So this is the last break of structure. This one, the last break of structure, right? So what do you see? This is the OB, the red candle. So let's just delete it so that we see what we're talking about. So this is the break of structure, right? Where is our OB? This is the order block, right? So that's the order block. You know how to identify order blocks. This is the order block. So I want you to ignore the order block for now, and I want you to focus on the candlesticks I'm trying to. So this is the 1, 2, 3 candlesticks, right? The wick, you understand the wick we are talking about. This is the wick, right? Then this is the other wick, right? So this gap is what we are terming the imbalance. So what happens? We have imbalance just before the OB. So price is supposed to come and retest this order block like this, to retest this OB like this. So first of all, it has to fill the imbalance. So when price is making its way up like that, okay, let me use this. When price is making its way to this, it gets here, then it fills the imbalance, retests the OB, then collapses down like that. Do you understand? So it's like this, fills the imbalance, retests, and we are done. So that's how price is moving here. So first, when price is moving, it fills the imbalance, which is here, fills the imbalance, goes to retest the OB and retest. So for you to find very good order blocks, you have to find order blocks with an inefficiency gap just before the OB. So we have this, right? Then we have that. So where is the imbalance? This is the imbalance. Where is the order block? This is the what? Sorry, let me just. So this is the OB. Understand? This is the OB. What happens? It fills the imbalance, reaches the OB, and we go. Understand? So this, in other terms, this can be called a fair value gap. It can be imbalance. It can be inefficiency. It depends on what you want to call it, right? Then let me show you a very bad example of an imbalance. We have this OB. If you look here, we don't have any inefficiency just below the OB. We just have wicks. Everything is filled, right? So this is not a very good order block. And if we want to consider this as an order block, this, like I told you, we don't have an imbalance, because if you look at this week, we have this week, right? and we have that week. You see, there has been some filling of gaps. There has been some there is no 100% selling or 100% buying here. Understand what I'm trying to say? Yeah. So that's imbalance. That's imbalance. That's what I'm trying to get across to you, so that you guys can understand what I am trying to convey to you. So this is not a very good OB. Why? Because it doesn't have a imbalance on top of it. Do you have an imbalance here? No, we don't have here. Look here, there's no imbalance. But here we have this OB, we have this order block or that rejection block, as you can see, right? That's what we have, right? And we have this imbalance. We have that imbalance. Then we saw prices to fill the fair value gap, retest the OB, and we go. So these are what I call odd enhancers for you to be using in your trading. So you have to have this. Let's look at another example if we can find something of that nature. Here we don't have anything interesting here. This is EJ. Let's look at AU. Do you have anything on AU? Yes, it looks like we have something here. Let's do this. Let's do this. So this is AU. What do we have? We have a rejection block. This is what we call a rejection block, and this is what we call a fair value gap. So we need a gap first, like that. We need a gap. The fair value gap. What do we need? We need price to fill the gap first. So we need price to move something like this, fills the gap and retest our OB, then go down like that. This is what we are looking for price to give to us. Understand? We don't trade off of the gap, of the fair value gap. We wait for price to hit the OB, but it has to go through the fair value gap just to fill the gap, then it gets to order block and we go down. So that is imbalance. What I want from you, I want you to go. You remember, these things work hand in glove. So we talked about order blocks, we talked about something else, we talked about refining order blocks and everything. Now, what I want you to be thinking about as we go through this course, I want you to be able to integrate these concepts, to apply them to a single chart. You draw your order block, you refine your order block, you identify your fair value gaps. Do you understand? So from now, we are stopping at fair value gaps, and I want you to go mark your charts, mark everything we have done so far. Put in your fair value gaps, put in your order blocks and everything. So yeah, that was it for today. I wanted to talk to you about fair value gaps and imbalance. Questions?